This is a Brooklyn-bound 2 train. The next stop is Wall Street.
Stand clear of the closing doors, please.
Welcome back. This is Not Your Advisor with NYU Grad on December 27th, Friday. Hope you all had a great holiday week if you celebrate. I have a lot to cover, just being away from the markets a little bit. But today was a pretty active session. So let's kind of peel this onion. I don't want to go off too on a tangent before I cover the breadth numbers. So I'm recording this exactly at 3:35 New York time. Obviously, we have 25 minutes to go. I don't suspect much change right now as I'm recording. The Dow is down almost 400 points. The NASDAQ is down 346 points or 1.7%. The S&P is down 79 points or 1.3%. So, bloodbath. So, we had 107 new highs on the NYSE versus 176 new lows. That doesn't tell the story, though. We had 18% of shares advancing versus 80% of shares declining today. 69% of stocks were below the 50-day moving average, and 50% of stocks were below their 200-day moving average. Now, volume has come back. Typically, as you know, I whine about the declining volumes every day. I whine about it. I beat and moan about it. But right now, as we speak at 3:36 p.m. New York, there's about 41 million shares of SPY traded. Now, the average daily volume used to be 70 plus million every day, and it's been declining all year into the close of the year. But this is average, so we're about on average. Like with 20 minutes ago, the average daily volume is now 45 million shares. We'll probably get there last 2 minutes with some robo spikes, but volume has come back, and every time volume comes back, we have a sell-off. That's not good complexion, yo. It's almost akin to like saying we can only sell merchandise when things are 40% off at Banana Republic or at the Gap, right? Like you can only move product if it's 80% off at Macy's. That's not a good sign. Every Mag 7 is red. All of the best defended stocks that I share with my premium members are red. If you take a look at the sector groups today, they're all red. Every single one. Consumer cyclical is down 1.9%. Technology is down 1.6%. Communication services is down 1.3%. Real estate is down 1.02%. Industrial is down 1.08%. Financial is down 0.86%. Basic materials down 0.75%. Healthcare down 0.75%. Consumer defensive down 0.7%. Utilities down 0.58%. And energy down 0.14%. So if today, going into the new year, low volume, if it was low volume, like 20 million shares traded on the SPY going to the close, yeah, maybe it doesn't matter, right? Like it's a moot point. But the volume is back. There's pretty heavy volume on things like Tesla and NVIDIA. Tesla and NVIDIA are down the most on the Mag 7. That's not good either. So the complexion is pretty bad. And I don't know, and I would love to hear some of the comment in the comment section, what you've been hearing throughout Thanksgiving week in the US to Christmas week to Boxing Day in the UK. What are your friends and family saying? I'll give you some quick summaries of what I've been hearing from my family. And I have family who are very smart, who invest, who have 401ks, they're in biotech, healthcare, finance. I have one cousin who makes 7 figures on Wall Street, at Wells Fargo as a trader, and everyone is saying you need to be long and strong, and you need to be using 2x, 3x levered ETFs Because if you don't have leverage, you can't really make your nut for the year, and you can't really make real money to pay for your 2-3 kids to go to private school, and the house and the backyard and the BMW, the Mercedes, the G-Wagon. You just need to be triple levered. You got to trade TQQ, right? Like, be long TQQQ and be strong. Just let it ride. Volatility might kill you, but it'll always come back. These are just some of the things I'm hearing from the past week. And I shared this with my premium members. I don't share what I do professionally full-time with my family because there's multiple reasons. But I don't share it publicly either, right? Like I have a pseudonym or handle of not your advisor, more of a legal thing, right? I talked to my lawyer, and I thought that we all came to an agreement that if you name your website not your advisor, you have a disclaimer, and it helps with that. But my point is that I don't want to reveal my true identity because I have connections on a senior level. I'm not talking about like directors. I'm talking about SVP, global roles at Google, at Meta, at Adobe, at Microsoft, at a few of the Masa SoftBank companies. So if everyone knew who I was, and I write something bad about whatever, like I've said some things about Adobe. I love Adobe, okay? But if I say what I want to say about Adobe and the chart, I might get calls from a global VP at Adobe like, hey, what the F? Why are you saying negative things about our company? So that's the primary reason that I'm not sharing my identity, because I want to be able to have the freedom to analyze and share with you all how I feel about a certain company or stock. But with the family members, they obviously don't know. And when I say obviously, there are a few people that can push your buttons like family, right? And I hear all this chatter about stocks and finance and trading. I have a person who does only 0 DTE trading. And they're like, yo, you just gotta do 0 DTE trades and manage your wealth and get wealthier. Like, it's so easy. I'm telling you right now, anyone who tells you that day trading or trading your own portfolio is easy, run. It is the hardest thing one can endeavor to do. Outside of going to war in the battlefield, risking your life, outside of being an EMS driver and picking up the pieces after a horrific car crash, outside of the emergency room, outside of any of those type of professions, because those are obviously physically demanding, but they're more psychologically demanding. Outside of those really huge, emotionally charged fields, I believe trading full-time is the hardest thing one can do. So if anyone says it's easy and you can day trade and learn, in a week how to day trade and, put in 100K and make 10 million, run away. Do not pay for any of their subscriptions. Just run. This is the hardest thing to do. I am still learning at my tender age of 40-something. And I hope, just like Bill Cara, I can continue to learn and teach and learn and teach until I'm 80 plus years old, until my last breath, because there's just so much to learn, and it's a psychological battle. The psychological part of this is the hardest effing part of it. Sorry for my rant, but it's important. Let's keep going. So what was strong? What was weak in the S&P and the NASDAQ? It's going to be a short list because on the long side. The S&P, as of 3:40 p.m., there were two that were up on my list. Lamb Weston Holdings in the S&P 500 up 3%. APA Corp up 1.1%. That's it. In the NASDAQ 100, you had Biogen up 0.72%. None were above 1% on gains. Illumina up 0.49. Mondelez up 0.38. Kraft Heinz up 0.26. That's it in the NASDAQ 100. What was weak in the S&P? Tesla down 5. SMCI down 4, Palantir down 3.6, Vistra Energy 3.2, CrowdStrike 2.5, Quanta 2.5, Norwegian 2.5, Carnival 2.4, Nvidia 2.4, GE Vernova 2.3, Apollo 2.4, Fastenal down 2.3, Expedia down 2.1, Axon 2.05, Texas Pacific 1.9, Builders FirstSource 2.02, ServiceNow 2, KKR 2, Netflix down 2. In the NASDAQ, you had Tesla again. It's just Tesla's in every index. Down 5. SMC, down 4.1. AppLovin, down 3.9. MongoDB, 2.5. CrowdStrike, 2.5. NVIDIA, again, 2.3. Fastenal, again, 2.3. Marvell, 2.06. Netflix, 2.05. If anything, all of these stocks should only be in one index. There's no reason for Tesla to be in every index. So for free members, I want you all to continue to focus on the forest and not the trees. If you can just watch one thing, I would say it's important to watch the 10-year Treasury yield, because we are above 4.5%, which is my line in the sand. While working as an executive at a Mazda SoftBank company, I had front row seats to the SVB collapse. A lot of my friends in my network who work for startups in, let's say, either publicly traded or private companies that are trying to go IPO, that have anywhere from, 2,000 employees to 5,000 employees, they're all struggling. They're all trying to cut costs, and we may see another SVB part 2, because what happened was, although the company I was with was able to bypass the SVB risk, we moved all of our money to one of the Fortune 500 top 3 tier banks. Our vendors who owe us, people who owe us, could not pay us, which hurts our cash flow to pay our employees. So there's a trickle effect of these Russell 2000 companies who are now having to continue to pay these high interest rates, who are running out of cash, who don't have the cash flow, who have too much overhead. And we may see another SVB in the system. So, I'll close here. It's 3:48 p.m. New York. The Dow is now down 439. The Nasdaq is down 370, or almost 2%. The S&P is down 85 points, almost 1.5%. We're gonna close near the lows, and the volume was legit. So you're gonna have to, if my family, long and strong, buy TQQQ and YOLO, you're going to have some acid reflux over this weekend, because we do not know what's going to happen next week. I've given enough warning. I've been telling my premium subscribers to stay in safety probably since May. Was I early? Maybe, but was I prudent? Yes. Just as a quick housekeeping reminder, we're heading into 2025. I have a lot to be thankful for. I did not want to do another discount, but in the spirit of the holidays, going into 2025, as well as what I suspect is going to be a very volatile start of the year, I do have a 25% discount. It ends midnight, New Year's Eve, New York. It's easy to get the discount. Just go to notyouradvisor.com/DEC25, as in December 25, DEC25. It comes to 73 cents per day billed monthly. It's well worth the investment. You can use it as an educational tax write-off. I welcome you all from the free side to come over to the paid side. We'd love to have you. Have a great rest of your Friday and have a great weekend. And I'll see you all. Premium members, please stay on. I do have about 20 charts to walk through today. That's my train.
Stand clear of the closing doors, please.